Welcome back to The Explainer. So let's just jump right in, shall we? Today we are tackling something called the yield mirage, escaping the safe asset trap. Okay, let's start with this quote right here. Leading you into a mathematical slaughterhouse. Wow, that is from CPA Brian over at the platform Hidden Tax, and man, is that a wake-up call. It's super visceral, right? Basically, he's warning us that following the old school advice like stuffing 40% of your cash into treasury bonds for safety. Section 1. The safe asset trap and the myth of the 60-40 portfolio. So to understand this trap, we kind of have to look at the bait first. And that's the classic 60-40 portfolio. You know the drill. 60% in stocks for growth and 40% parked in fixed income stuff like bonds for that warm, cozy safety blanket. Right now, a lot of folks are looking ahead to 2026 and thinking, hey, a guaranteed 4% yield? I'll absolutely take it. You log into your brokerage account, see the balance tick up, and you feel totally insulated from market craziness. But, and this is a big but, our sources argue this psychological comfort is a dangerous illusion. While you're patting yourself on the back for that 4% win, there are massive, invisible forces just completely eating away at the real-world value of your money. Which brings us to Section 2. The purchasing power squeeze, and the math behind the mirage. Alright, let's get down to the hard arithmetic here, because this is where that cozy narrative totally shatters. You've got your nominal yield. That's the 4% sticker price your T-bill promises you on paper. But you've got to put that directly head-to-head with real inflation, which the source puts at a pretty stubborn 6 to 8% right now. When you put those two distinct realities side by side, oh boy, if you're earning 4% but your groceries, rent, and gas are going up by 6 to 8%, you aren't actually saving any money. You are fundamentally, mathematically going backward every single day. And that leaves us with this number, negative 2%. Listen, this isn't some temporary stock market dip. This is a guaranteed, locked-in mathematical loss. If true inflation is at 6% and your yield is 4%, you're losing at least 2% of your purchasing power every single year. Think about it like going to the grocery store. You technically have 4% more dollar bills in your pocket this year, but your weekly grocery bill just jumped 6%. You are literally walking out with fewer groceries. You aren't getting a bill in the mail for this penalty, but it's relentlessly draining your wealth just the same. And remember, negative 2% is the absolute best case scenario here. If inflation hits that 8% mark our source mentioned, your silent penalty instantly doubles to a 4% compounding loss year after year. Yikes. Now throw federal taxes into the mix, and it turns into a total wealth-killing machine. It's almost funny in a really sad way. You get that positive 4% paper gain, and inflation immediately drags your actual spending power into the negative, right? But guess what? Uncle Sam doesn't care about your real-world loss. You still enthusiastically owe taxes on that 4% nominal profit. So you are forced to pay real taxes on a phantom gain. By the time inflation and taxes take their cut, your supposedly safe protective investment is just siphoning away your money. Talk about a double whammy where you're penalized for playing it safe. Moving into Section 3, the macroeconomic theater, and ignoring the noise. To really wrap our heads around why we're caught in this inescapable math, we gotta zoom way out. CPA Brian says we need to tune out the daily news cycle and look objectively at the broader picture. And that big picture looks like this, $39 trillion. That staggering number is our national debt. Just to put that totally bonkers number into perspective, 1,000,000 seconds is about 11 days. 1,000,000,000 seconds is roughly 31 years. 1,000,000,000,000 seconds, that's over 31,000 years. Now multiply that by 39. It is almost unfathomable. But that living, breathing mountain of debt is the literal driving force behind the silent penalty we just talked about. It actively dictates what the dollars in your wallet are actually worth. So Brian argues this debt creates a structural inevitability, basically a debasement cycle. To manage a debt that absolutely huge, the system relies on endless government overspending. And since expenses way exceed the actual revenue coming in, how do they cover the gap? They print money. They literally just create it out of thin air. But the unbending rule of economics is, when you flood the system with millions of new dollars, the value of every existing dollar proportionally drops. That's the textbook definition of currency debasement. And that, my friends, is exactly why those fixed income returns fail so predictably. The continuous printing mathematically guarantees your fixed returns will forever lag behind true inflation. Which brings us to Section 4, building your financial fortress and escaping the trap. Okay, I know that all sounds super bleak, but take a breath, because there is a clear, strategic way out of this. The source lays out a really powerful solution to stop being a passive victim here. It's called building your opportunity bucket. Instead of stubbornly clinging to that failing 40% of the old 60-40 split, you intentionally focus on acquiring hard assets. By definition, this is a dedicated strategy focused on things that simply cannot be printed, replicated, or inflated away. Honestly, you gotta ask yourself right now, does your portfolio rely heavily on paper promises that are losing value, or do you hold tangible value that a government printing press absolutely cannot touch? This shift is the only genuine mathematical protection against the squeeze we're seeing. So what exactly goes into this opportunity bucket? Brian's advice is clear. Assets they can't print. The classic historical example here is gold. It's the ultimate hard asset, right? It carries a strictly finite supply, takes immense physical energy to dig up, and has a proven track record of holding its value over centuries. A central bank can't just vote to make more gold. The source also points heavily to high conviction plays. Now, they don't give us specific stock tickers, but the implication is pretty obvious. Do your deep research and invest strategically in scarce resources, critical commodities, or businesses that have true, irreplaceable value. By decisively moving part of your wealth into these deeply scarce areas, you completely flip the dynamic. You put the math back in your favor. Which leaves us with the ultimate takeaway and the most critical question of today's explainer. Is your safe money actually safe? After looking objectively at the raw math, the brutal combination of inflation and taxes, and that looming $39 trillion debt driving the system, you absolutely have to ask yourself this today. Take a hard, honest look at your own portfolio construction. Before you just blindly trust that historical 60-40 split or celebrate a 4% yield, make absolutely sure you aren't secretly paying that massive wealth-draining penalty. Run the numbers on your own stuff and assess your true exposure. Well, that is a wrap on this explainer. I hope this deep dive gave you a totally new, powerful lens to view your financial fortress through. Keep learning, keep questioning the conventional wisdom, and I will catch you on the next one.